Good morning, everybody, and welcome to our Holborn series of webinars. I'm your host today, Lawrence, and thank you very much for everybody that's joining us, not just in South Africa, but from around the world at our Alternative Investments webinar. We really appreciate the time that you're spending with us, and we hope that this is very useful for you to join as well. Many of our clients are on this call, and some of our prospective clients as well. So it's lovely to see everybody. Nice group already, 70 have joined. We're expecting in excess of 100 people that will be on the webinar today. There will be a Q&A session at the end for questions for Tim. So please do put those comments on the chat box, and we will get to them later. Thank you very much. Okay, so why did we decide to hold this webinar today? Well, it's probably wise to look at what has happened in the world over the last 18 months to 2 years. The coronavirus pandemic has, without doubt, changed the way human beings behave and work. And one of the biggest changes is the work from home scenario. And within the work from home scenario, companies have realized that they can get the best out of their human beings still whilst they are at home, which traditionally was never the case. And have said to their employees, you are more than welcome to now work from any location in the world. If you take my own personal circumstances, I was working in Johannesburg and traveling between Johannesburg and Cape Town and the rest of the world to see clients. And many clients who are on this webinar today, I have not physically seen for the last year and a half. And but we have communicated way more than we traditionally have. And I then, with the expectation of our new baby arriving, my wife Taryn said to me, can we move to Cape Town to be closer to my support network? And I said, no problem. And we were able to lift up from Johannesburg. We were able to move to Cape Town. And I've still been doing my job. And in fact, our business has increased and our reach has increased. And companies around the world, our company being one of them, have jumped on this and realized the enormous power there is in the reach that you have, even with people being able to work from home. What that has meant in the rest of the world is that we have had a huge shift in where people want to move away from expensive metros and move to other parts of their country. And so in Germany, we've seen a reduction of people in Frankfurt to want to rent places, but an increase in places like Berlin, where the rental is a third of what it is in places like Frankfurt, and property prices as well. What we've seen in the United Kingdom is a move north, away from the London metropole into the northern powerhouse, as it's called. And what we've seen in the United States is a move towards the southern smile, the southern belt of states, because I'd rather live in Florida or Texas than I would in New York in that weather for twice the price or 3 times the price. So I won't share too much more about that story, but we have seen a huge shift in how human beings travel and behave in terms of employment and work and living. And as a result, we want to follow that flow of capital. And I won't say much more about that. And today I want to introduce the Walton Group and Tim, our speaker. Let's first start talking about Tim. So Tim has spent the last 20 years in the world of financial services and real estate, and the last 14 years with the Walton Group, which is based traditionally out of Canada. He joined Walton in 2007 whilst he was in Hong Kong, and then he relocated to Dubai, where he is today, and to establish their Middle Eastern business. And he's responsible for all the business in the EMEA region. And He's got a huge depth of knowledge in the US real estate market. He's married. He's got 2 kids. He's one up on me. He's a former rugby player. So those of you who are South African, you can ask him what it feels like to be English and rugby fan speaking to South Africans. What's the score again? Anyway, so he now is retired from rugby, probably around the same time that South Africa beat England in the Rugby World Cup, and he now focuses on golf. So without any further ado, Tim Haywood from Walton, we welcome you, and over to you.
Thank you, Lawrence. And the less said about the Rugby World Cup, the better. But there we go. All I can say is let's bring on the Lions, and hopefully we get some better results there. So thank you everybody for your time this morning. It's a privilege to be here and to be presenting to you. And I'm going to talk to you about the Walton Group of Companies and, of course, our US land asset business model. So the first thing is just, and again, I'm going to skip this because Lawrence has covered it, but really in a nutshell, what is our business? Well, we offer a fully packaged US land investment solution, and we partner with publicly traded home builders whilst targeting a 12 to 15% per annum IRR, focused on annual cash flow distributions to our investors. And I think really, in a nutshell, that captures the essence of what Walton does and what we bring to the table. But of course, there's an awful lot more to it than that, and I'm going to go through our business model for you today. I think before we start, we've really got to understand and appreciate the value of land in the real estate life cycle. And of course, before any home is built, any commercial premises are built, any retail centers are built, ultimately it all starts with land. And that for over 40 years has been Walton's specialty. We focus on creating those wealth opportunities in the early stages of the real estate life cycle and broadening access to land investments, which have traditionally only been available to a limited pool of investors. And I think, you know, if you sit and ask yourself, you know what, did I even know that land investment was a thing, was an option? I think most of you would probably say no, because it's just not available to most retail investors. So there are four key stages to the real estate life cycle. The first, of course, is the research and acquisition of path of growth land or pre-development land that is suitable for large-scale residential development. Stage 2 is then when the horizontal development takes place, where the infrastructure, the water, the sewer, utilities are all brought onto and through the land in preparation for stage 3, which is when the home building activity commences. Now, in the United States, that is really driven by the large publicly traded home builders, the likes of D.R. Horton, Lennar, KB Homes, Meritage, all of these kind of groups who are building substantial, and when I talk about substantial, I mean tens of thousands of homes across the US every single year. And once, of course, those homes are constructed, then they sell them, and you end up with stage 4, the fully developed live, work, and play community. So just to be clear, Walton's focus and the opportunity that we bring to you today is focused on stage 1, the pre-development land investment opportunity. And I'm going to go through that business model for you in some detail. Before I do, I'd just like to introduce you to the Walton Group of Companies. We are a real estate asset management firm, and really our tried and tested formula is all about our 4 stages. First and foremost, identifying the parcels of land that meet our stringent acquisition criteria. We then syndicate the properties to our investors with a predetermined exit strategy already in place. We then look to protect the value of those assets during the holding period, and then work with those home builders to divest those properties on a phase-by-phase basis, which in turn generates cash flow for our investors. And I'm not going to go through all of the high-level numbers there, but suffice to say, you can see we have a substantial asset base under administration, a substantial footprint in terms of acreages, and of course, a substantial investor base, and importantly, returned a substantial amount of money back to our investors since inception. Now, not only do we also have an extensive portfolio of land assets, but we also bring to you our expertise with a significant network of home builder partners. And the reason this is important is because it shows our strength in depth. It also demonstrates who we are supplying the raw material of future development to. And these are the largest home builders in the United States. And thirdly, it demonstrates how we're able to generate an exit return for our investors by partnering up with these home builders on a national and regional basis. And I'll talk about these groups again a little bit further down the line. Before we go any further, we really need to understand the strong fundamentals of the US housing market. And for those of you that are perhaps not so familiar, I think this will be a good education session for you. First and foremost, the housing demand is driven by a continued and sustained population growth in the United States. Currently around 330 million people, but the US Census Bureau projects it's going to reach somewhere in the region of 350 million by around 2045, 2050. Now, allowing for different immigration and various growth policies, of course, that could vary, but suffice it to say that is a substantial population growth which isn't going to stop. Now, what you also see is the tracking of housing starts. And let me just explain what a housing start is. A housing start is when construction commences on a new single family or multi-family home in the United States. And it's probably one of the best indicators as to the strength of the home construction market in the United States. And it's one of the monthly reported economic indicators that you see in the United States. But what you can see here is a graph going back to 1970. And of course, we all understand that, as with most things, housing is cyclical and typically tends to coincide with recessionary periods where you start to see some downturns, but fairly short, sharp recoveries in a kind of V-shaped recovery pattern. But what you saw in the run-up to the subprime crisis was something quite different. You saw a massive oversupply of housing in the United States running through 2004, 5, and 6. And then, of course, the subprime crisis hit and the real estate crash that ensued, and of course, the global financial crisis. But what that led to in housing in the United States was a structural undersupply. And you can see that on average, around 1.3 million housing units are needed every year just to keep that equilibrium between supply and demand. But during those downturn years, 2008 through to 2017-18, you saw less than 1 million home starts every year. And what that has led to is, by industry estimates, somewhere between a 4 and 5 million home shortage in the US today. And so, as Lawrence alluded to earlier, not only has the COVID effect accelerated demand in suburban locations, but also this structural undersupply where the supply and demand imbalance is just completely out of whack. And of course, the home builders are now scrambling to secure land assets to meet the demand in the market. And that is really what we're seeing happening right now on the ground with the interest we have across our asset base. Now, what is driving that demand? Well, COVID, of course, has had an impact, but underlying the fact is that you've got a huge population of potential and existing home buyers. And the biggest cohort of the US population today is the millennial generation, which represents just over 80 million people in the US population. And you can see that your average home buying age is about 33. But also understanding the breakdown of that home buying activity. And on the right-hand side of the screen, you can see that 83% of the homes purchased, and therefore the demand, is for single-family homes. Now, single-family home is what you and I might call a detached home on its own plot. And that is really where the demand sits. But also look at that below. You can see 72% of those homes have been purchased, and therefore the demand is in the suburban markets, in those small towns or cities, as the US like to call them. And again, not in those urban centers where perhaps it's more costly. People are starting families, getting married, they want more space, they want a new home. And certainly with the COVID impact, with work from home policies, people are no longer having to go into downtown locations to work 3, 4, 5 times a week. You know, they're perhaps working from home 2 or 3 days a week, and that makes a big difference. Understanding then where the main demand is focused, is really key to understanding where we start our due diligence process. And so this outlines the top 25 metropolitan statistical areas, or MSAs, across the United States. And what you can clearly see is the pattern emerging, which is focusing that activity in those Sunbelt regions. So Walton's target markets, no great surprise, are across the Sunbelt from the Southern Inland Empire, the Inland Empire of Southern California, through into Phoenix, across into Texas, into Florida, through the Carolinas, in the Atlanta region, and up into the DC market. And if I was to overlay the major home builders activity, you would see a very similar pattern emerging across these same markets, because of course, the driver for growth in these regions is employment, it's affordability, it's low tax rates, and all of these things play a part to understanding what is driving demand in these respective markets. So one of the things that we saw take place after the global financial crisis and the subprime crisis in the US was a lot of home builders got burned, and they got burned huge. And a lot of them disappeared and they never came back to the market. So all of a sudden you saw a massive consolidation in the home building market. Now, why did that happen? Well, very simply because number one, the demand wasn't there in terms of home building activity, which you saw earlier, but also because a lot of these home builders were caught holding much too much long-term land on their balance sheet. So what happened as a result of that was that home builders started to run what we call a land light strategy. And that is to say that they held just enough land on their balance sheets to meet the demand for the next 12, 18, 24, maybe even 36 months at a push. And to secure their longer term land inventory, which of course they still need to plan ahead for future development, what they moved to was securing land through option agreements. And what those option agreements allow for them to do is to secure the land today and acquire it as and when they need it down the line. And that has allowed Walton to evolve our business model to deliver income solutions for our investors and to meet the demands of the home builders following this strategy. And to give you an illustration of that, you can see here the two largest home builders in the United States, D.R. Horton and Lennar. Now, what you can see in the gray is the owned or the outright owned land and lots that these two home builders control. And that is to say that those land and lots are fully bought, purchased, and they sit on the company balance sheet. Now, of course, if you're a Wall Street, a New York Stock Exchange listed home builder, and you've got too much land on your balance sheet, you're going to get penalized in your share price. It's not an efficient use of capital. So again, they've got smart to the idea of holding just what they need. But what you can then see in the blue bars is the substantial increase in optioned land and lots through this 6 years. And particularly with D.R. Horton, over 400% of their lands are now controlled through options. And again, with Lennar to a lesser extent, about 200%. But you can see there again, there was a bit of a spike in 2018 and 19 in the controlled land and lots they owned, and that is because they acquired other home builders. And so in doing so, they acquired their land and lot inventory as well. But suffice to say, you can see this has been an industry shift, and this is where our business model really does fit in with these home builders today. So that leads me on to our exit-focused pre-development land investment strategy, or EFPDLI, if you don't want to be running all those words off your tongue. And what this EFPDLI strategy does is it delivers, if you like, a journey for our investors. The first stage of this process is for Walton to identify and research the properties in question, the land assets in question, and then simultaneously, upon acquisition, entering into an exit-focused agreement with a public home builder. And again, what that exit-focused agreement does is it secures exclusivity for the home builder to allow them to work with Walton and the city, as well as our external engineering consultants, to advance the planning on the project and finalize the planning. Now in stage 2, which is highlighted, that is where we invite investors to participate into the individual projects. And so investors participate with individual title ownership in the form of an undivided interest structure, and I'll talk about that a little bit later. And all the way through, Walton is appointed as the agent to act on behalf of our investors and to take the land or the asset through the rest of the journey. In stage 3, we then look to enter into an option agreement with the home builder, which allows for the specified takedown of the asset on a phase-by-phase basis, which then starts to deliver the cash flow to our investors. And at that stage, investors then vote whether to accept or reject the terms of the offer, which is on the table. Stage 4 is when the final entitlement and development approval work takes place at the builder's cost, and that allows them just to finalise all of the site plans, all of the development agreements with the city before moving to stage 5, which is the first exercising of the option. And upon that point, they pay a deposit for the first phase of lots, which is then distributed to investors as cash flow. And then as they build and sell those homes in stage 6, the balance payment is also paid to investors. So when you look at this, you think stage 2 is my investment period, stage 5 and 6 is when the cash flow is generated for me. And so I think that gives you a good understanding of the journey. And I will show you a cash flow example as we go through the presentation. So the research and acquisition process is really the key to our asset acquisition. Ultimately, we need to make sure that the land is suitable for cost-effective, large-scale development in a particular region. And we're not arrogant enough to believe that we can do this all ourselves, so we do work with best-in-class partners as well. Metro Study, John Burns Real Estate Consulting are two of the foremost housing market analysts in the United States. But you can also see that we deal with engineering consultants externally, as well as having our own in-house team of civil engineers and urban designers. And this is important for a number of reasons. Firstly, this is our own due diligence to make sure that we are acquiring assets which are suitable for development. But secondly, and very importantly, we share this due diligence with the home builders who we're talking to. And so in order for us to secure their interest through an exit-focused letter of intent, we need to make sure that this research and due diligence is absolutely spot on and delivers what they're looking for. To give you an idea of what this due diligence process looks like, and I'm not going to go through these in details, but just high level. And again, this video, or this presentation will be available after the presentation. This is all about risk mitigation, understanding the land in its truest sense, understanding any and all constraints within the market, any issues that we might have and how we can overcome them. And you can see it is a pretty extensive list. We also work with technology. We understand the importance of technology, and technology allows us to map out physical, environmental, political constraints and opportunities within a given market. And so we use a geographic information system technology, which has allowed us to map out a substantial amount of acreage across the US, and ultimately only then acquire a relatively small portion in comparison. And to give you again a high-level overview of the kind of analysis that we look at, I'm not going to read all of these to you. You can obviously see the sub headings underneath. But in terms of the housing market analysis, we look at the housing type, we look at the price range, market by market, and sub-market by sub-market. We look at the number of housing starts and the closing activity, i.e. how many homes are being built and how many are being sold market by market. We also need to understand the existing inventory in the market, because that is competitive to our own master plans and our own assets. And finally, we need to understand the presence of top communities in the market and the presence of top home builders in the market, because of course, if there are no home builders in the market, it's probably a fairly safe indicator that there's not really that much demand in the region. We also look at the feasibility analysis of the asset. So as you would expect, the legal reviews take place, understanding the title, all of the legal notices, any kind of leases and encumbrances on the land. The environmental site assessments take place with our external engineering partners, managed by our own in-house team. We run the financial models on the project to understand that we can deliver value for our investors but ultimately also that it's going to be attractive to a home builder to pay the price for those lots. And ultimately then finally the land use assessments take place to again understand the density opportunities here, the infrastructure, utilities, schools, all of these kind of things, which of course then play an important role as to why people want to move into these regions. So then we have our exit strategy, which again ties back into the home builders, which I talked about right at the start of the presentation. And again, we have a deep bench of home builders who we're looking to work with, and we have worked with, and this provides a great opportunity for our investors. So what we do is we sign these exit-focused agreements with the home builders, which again provides them exclusivity on the deal and allows them to work through the process with us and move towards signing the option agreement. And just to give you an idea of the assets that we've syndicated through the past year or so, this just shows you very quickly 6 of our projects which have been syndicated across the US in different markets. It shows you the home builder relationships that we have, led by D.R. Horton, who we have a very strong strategic partnership with. It also shows you the timeframes of these projects in terms of the projected cash flows and the projected net returns. So based on an ROI, return on investment basis, and an IRR basis, so internal rate of return. Now, I would challenge most of you to find an asset manager that can deliver you with these kind of returns. And I think if you're looking at stock market returns, you're going to be pretty hard pressed to achieve these kind of returns on a regular basis. So I think the important thing here for us is, number one, the success of these syndications. These are all fully syndicated out, so they're not available to you now. But also look at the status. The status of these projects. Number one, Lee Farms. We've already taken an offer out to our investors and they've voted on it to accept the terms of the offer. But those other 5 projects are also now at draft agreement stage with those home builders in question. So this means and demonstrates that the model is working. It delivers as per expectations, and in fact, in many cases, exceeds the expectations of the original underwriting. And if you'll allow me, I'm going to share with you a case study of that first project, Lee Farms, which was syndicated to investors back in 2019. And originally, the planning was for around 800 single-family homes after we discussed the feasibility analysis with D.R. Horton. That was going to deliver a projected IRR to investors of just under 16% per annum for about a 2x multiple. Now, working with D.R. Horton and the city, we were able to have those plans rezoned, or sorry, the asset rezoned for just over 1,000 homes. And that was going to deliver a projected IRR of about 17.7% to investors for a 2.5 multiple. Well, as of March this year, we moved forward and signed the option agreement with D.R. Horton, and we delivered a base case exit offer to our investors of 18.55% per annum for a 2.52 multiple, but with an upside opportunity based on D.R. Horton believing they can squeeze some additional density out of the project during the final entitlement processes, delivering an IRR of just under 21% to investors and a 3x multiple. So no great surprise, as of April this year, that was fully approved by investors and it is now moving forward to closing. So there's a couple of things to point out here. I think obviously one, that the model works and the home builder relationships that we have are very strong. But I think more importantly than that is the fact that we are conservatively underwriting these models with a underperform, over-deliver viewpoint. And I think when you look at this, you can see the projected IRR when it was syndicated to investors and the ultimate IRR based on the exit offer delivered in March this year. And so when we're underwriting these deals, we are doing so on a fairly conservative basis for our investors. And again, you can see a demonstration of that in this slide, which shows you the projects which have been syndicated as of 2019. And you can see the status of them, both in terms of the original projected return versus the latest returns as per discussions which are underway right now. And in most cases, they have actually exceeded the original underwriting and delivering very healthy returns to our investors. So with that, I'm conscious of time, but I do have an opportunity to share with you today, which is an exclusive preview for you. This has not been shared anywhere else in the world so far. It is an upcoming project which we are in the final stages of closing, and it's called Chaparral Ranch over in San Antonio. So again, very high level. I'm going to run through this fairly quickly because I am conscious of time. This project is located in the great state of Texas. And just some fast facts for you: 29 million population. The capital is Austin. It ranks second in terms of population rank in the US, and it has a total area of 269,000 square miles. It is a huge, huge area. Median household income as of 2019 was just over 60,000. And of course, you can see it's one of the best states for business and for growth. It's got a strong, diverse economy, not only in terms of tech and data. It's a great state in terms of trade, top exporter for 19 years, with exports valued at 279 billion in 2020 alone. Of course, it is a gateway to global trade. It's got the deep water ports, and of course, an extensive air and rail network as well. It also has got a diverse economy. It's not just oil and gas, as many people may think. It's tech, it's data, it's aerospace, and of course, it's got a very highly educated workforce and some of the biggest universities in the US. I think this is really interesting just to give you a sense of the Texas Triangle, which encompasses the Dallas-Fort Worth metro area, the San Antonio-Austin corridor, and the greater Houston region. And I think it's worth just understanding the sheer scale of this area, this Texas Triangle. It is huge. And of course, people think about the big centers of New York and Atlanta and over in California, but actually this region is very, very strong itself. Some of the most populated markets in Texas, and again, you can see there, so the densest population that you see in this region, huge population base, 18 million residents in this region, and it accounts for about 66% of the population of Texas as a whole, and 77% of the GDP of the second largest state in the nation. It is absolutely huge. And they always joke that they do it bigger in Texas. Well, it just demonstrates and goes to show they're absolutely right. It's also very, very well connected. It's got a great interstate network, and the importance of the interstate network in the US cannot be understated. You know, you've got the I-45, the I-10, and the I-35 all running up through this area. And of course, that allows for the transportation of goods and services throughout the US and of course beyond. Quick regional snapshot for you. You can see here that very strong economic outlook in this region, in the Austin market and San Antonio. So again, this corridor is very strong, and a good diverse workforce as well. Government, wholesale and retail trade, financial services are in here, as well as, of course, education and health services as well. So again, it's not just oil and gas. In migration, an important part of population movement within the US, understanding why people are moving into these regions. And again, we talk about affordability in terms of homes. We talk about employment opportunities, cost of living, taxation. All of these things play a big part as to the movement of people from the more expensive urban centers into these regions. And again, as Lauren's alluded to earlier, accelerated by COVID. And again, one of the strongest real estate markets in the US, high demand, record home growth, again, because of that lack of supply coming through at the other end. It's putting pressure on existing inventory. And again, the housing market overall is very, very strong. Looking then, drilling down into the sub-market analysis. And again, this is where we do our homework to make sure we understand the sub-market that we're entering into. This is from Metro Study. It just shows the number of home starts and home closings in this market. So it's in fairly tight step. Your average home price is about $320,000 for around 2,200 square foot. You know, so your dollar goes an awful long way in the US. And of course, this isn't relevant to our investors in the sense of they're not going to go and buy a home, but it is relevant into the as it speaks to the demand of the market and why people are looking into these markets and these regions. So Chaparral Ranch itself is surrounded by existing existing access and infrastructure, employment bases, amenities, and of course the big box retailers that move into these areas because the area is growing as a whole. And you can see the prevalence of the interstate highway network here, the I-10, the I-35. I mean, ultimately the I-10 goes right across the top of Florida and Jacksonville, and ultimately connects out to the West Coast. So again, the importance of the interstate highway networks is not to be underestimated in terms of transportation of goods and services throughout the United States. The project itself is 165 acres. It's about a $7.3 million syndication, and we're just in the final stages of the final engineering approvals for around 439 lots. We are currently in discussions, and this is not finalized yet, but we're currently in discussions with Lennar, Meritage, and KB Homes, who are looking to sign that exit-focused agreement. And the projected lot takedown of this project will be from 2023 through to 2027, delivering an average IRR of 13% per annum and a 1.53 ROI. Just to give you some quick aerials, you can see how it sits in with existing development. You've got D.R. Horton just down the road in the Aurora Ranch, and you can see the kind of product which is being built in this area, all with amenities, with clubhouses, with pools, all of these kind of things. This project sits within the Seguin subdivision map. You can see here it's under plat review at the moment. Number 3 there, 418 housing units, and that is the project. And the exit strategy for this will be based on the model I showed you earlier. So we're currently in the initial builder interest and the signed exit-focused agreement stage with the home builders. That will be completed in fairly short order. And then we'll be working towards the signing of the option agreement with those home builders in Q3 to Q4 next year. And that will then trigger the voting for investors and the final due diligence, and then the first phase takedown from 2023 onwards, and the home sales activity commencing in 2024. And that is based, and that will deliver the cash flow as per that time frame as follows. So what you can see here is the lot takedowns in 2023 and 2024. So it's a 2-phase takedown strategy for the 439 lots. And on the right-hand side of your screen, what you can see here is based on the different investment amounts. You can see the annual cash flow anticipated to come back to investors in each of those years. And the way that cash flow is generated is from the deposits that the home builder will pay for those phases of lots, and then the balance payment or deferred payment will be generated through the home sales which takes place each year. And so there's a balance of payments between the deposit and the home sales activity as well. So finally, just to cover off the security of the investment in terms of ownership, what you're looking at here is an investment of $50,000 entry, and that is into an individual project or projects, depending on what we have available, in the form of what we call an undivided interest, which, for want of a better expression, is a fractional ownership within a particular project. And what that means is that everybody's entry price is the same per acre, and everybody's exit price is the same per acre. There is not one preferential plot within the project. Everybody shares in the overall planning and interest in the project. What investors are receiving for that is the ownership through the recorded deed and the title insurance structure. And that is independent of Walton. It's issued by First American Title Insurance, and that confirms the title is clean and clear and unencumbered. On the back of the sales and purchase agreement, we set up a revocable trust, which allows for individuals to nominate beneficiaries. God forbid the worst should happen. And of course, as a registered landowner on title, you have direct control through voting. And so when we present an exit offer to investors, investors vote, and a 60% threshold or majority will carry the decision or carry the vote. So 60% of the investors returning their ballots vote in favor or against the offer, then it will be binding on everybody. And of course, Walton is the agent on your behalf all the way through the process. The title insurance issued by First American Title Insurance Company, as I say, just to confirm that that is independently verified, and that is the title system in the US. And so in summary, What we're providing here is a pre-identified builder for the future exit. So there's some assurances in terms of the exit strategy. The builder then at their own cost prepares for development ahead of exit, which means it's much stickier in terms of a deal. Once those home builders start spending money, they don't want to be walking away from those opportunities. And for our investors, of course, that provides clarity on exit timelines and cash flow projections that they can expect to receive. And ultimately, that investment return is a capital gain based on diversification into a low volatility alternative real estate asset based on future demand for residential development in the United States of America. So with that, thank you very much for your time. I appreciate it. And I believe, Lawrence, that we're going to have a Q&A session if we have questions.
Fantastic. Thank you very much for that, Tim. Thorough as always. Appreciate it. Okay, so guys, please, and girls, please do type your Q&A on the Zoom. I will start with a few. So, firstly, one from Heinrich. How secure are my property rights? And in the case of default, can I end up with a piece of property instead of my original investment?
Yeah, so in terms of security, the title deed of the investment is government issued. So it's as good as it gets, depending on what you think of the government, I suppose. But it's as good as it gets in terms of the registration. It is registered with the local land registry office, who issues title. So, you know, much like ownership deeds to an apartment or a detached home, you physically have that ownership within the project. In terms of default, ultimately you remain as a landowner. So if Walton, for any reason, disappeared, you would still remain on title as a registered landowner. But again, you know, the fact that we've been around for 42 years, never say never, but I think we're a pretty safe pair of hands.
Good stuff. And there's lots of questions coming in. So one from Gerard. What is the tax treatment? So let's say someone is resident, for example, here in South Africa. What is the tax treatment in the US, especially with the complicated US tax filings, etc.? And also, what is their tax treatment in South Africa?
Yeah, so I'll handle the US side, Lawrence. So in the US, this is treated as a capital gains tax, and so you're taxed accordingly on that. Now, the structure of the US for non-residents investors is that 15% withholding tax will be applied upon exit, and then you are filing for recovery of any unused amount. Now, the beauty of this structure is that it is considered as a long-term real estate hold because it is held for more than 12 months, which straight away means that it falls into the 0 to 20% tax bracket. You also are able to benefit from a $40,000 per year per person federal tax threshold, which basically states that if your capital gain is less than the $40,000 threshold, you're going to pay 0 federal tax on that. So it's very, very competitive. There may or may not be state tax involved. In the great state of Texas, there is 0 state tax, so it's one of the cheapest regions. But if anybody does want to look at this in more detail, we can prepare tax examples for you. And so please reach out to your wealth manager, and we will be able to prepare tax examples based on different scenarios that you may wish to see.
Wonderful. Then one from Bernadette asking, what is the difference or the definition of ROI and IRR?
Okay, so IRR is internal rate of return, and it's effectively, and it's not quite, but it's effectively a compounded rate of return, which is well used in real estate calculations. So that is your IRR. ROI, return on investment. So for $100,000 invested, if this project is looking at a 1.53 multiple, then you're looking at $153,000 back.
Wonderful. Okay, and then one from Adrian. Can a US citizen invest in this?
Yes, they can, as long as that a US citizen is non-resident, i.e. resides outside of the US at the time of investment, then yes, they may, and it is completely portable for them to take back should they repatriate to the US at any time. And just to cover off on the tax side, just because I think it's worth mentioning, of course, US citizens are not subject to withholding tax because they're taxed on a global basis. So straight away, there's actually a benefit there for US citizens.
Okay, and then one from Manish out in Singapore saying, can any loan or mortgage be taken on this land, and how is that $50,000 investment utilized?
Typically speaking, no. Most banks that I've certainly come across won't lend on raw land. So I don't think that's applicable. And in terms of how the $50,000 is utilized, of course, that is partly the land cost, it's partly the management cost, distribution fees, but your return is based on the $50,000 invested or whatever amount you invest, not the $50,000 less fees, costs, etc.
Great stuff. One from Heinrich, Tim. How, where, and when does Walton make their money? Is it from the initial deposits? Is it after completion? Or after all the investments have been paid?
Yeah. So we make money in two ways. We make a small profit on the front end. So when we acquire the land and then we syndicate it to investors, we look to make somewhere in the region of a 12% profit. We are a business after all, not a charity. Secondly, we make money at the end. So we take a 3% disposition fee upon exit. And so therefore we are incentivized to not only ensure that that exit offer is achieved, but also that we achieve the best and highest price for that. And just to be clear, the numbers that you see in terms of the cash flow and the IRR projections are all based, are fully encompassing of those fees.
Thanks. And one from Mark, an interesting one. Does the management, and I assume Walton, invest alongside the investors in the real estate assets that's managed?
Yeah, that's a great question. And yes, we do. We have reduced the amount that we invest because of the structure of the investment now with the cash flow and the fact that it's a very short hold period. But yes, Walton does retain a co-investment position with investors, typically to the tune of up to 5%.
Okay, and one from Neil. Are there any business visa or residency benefits for a US investor? Is there any amount that you could put in that actually gets you some sort of a benefit in terms of residency or visas?
Yeah, and it's an often asked question, and the simple answer is no. And if I can just elaborate, the reason for that, just so you understand, is because for the EB5 program, typically it needs to be an asset which is creating direct jobs in a region. And of course, this being a land asset, until such time as the development work commences, then it's not creating direct jobs, so it doesn't qualify.
Okay, thanks. One from Heinrich. Can Walton produce a certificate for SA investors for tax purposes, so split between capital return and capital gains tax, for example?
What we do is we actually, for the tax filing process, we provide a service through RSM, Global Tax Advisors, for a fee, and they will do all of the federal and state tax filing requirements on behalf of investors. So what will happen through that process, obviously, is you will receive your tax filing returns, and then that will allow you to lodge that as applicable with your South African tax authority. And of course, depending on those double taxation agreements that are in place, you wouldn't be taxed on the same amount, but any difference between the two, then obviously you may be subject to paying that tax if you repatriate the proceeds to South Africa.
Great, thanks. And then one from Costas. Can this be owned by a US company rather than in your own personal capacity?
It can be owned by a corporation, but I don't believe it will be able to be owned by a US corporate for the simple reason of the same, talking about the US citizens earlier, they would need to be non-resident at the time of purchase. And the simple reason for that, just so you understand, is because in the US it would have to be structured as a securitized offering, and of course registered with the necessary authorities. And of course, this is a direct land ownership structure. It's not wrapped in an LLC structure or anything like that. So I don't think so, but I can double check that.
Great stuff. And then another one from Heinrich. What are the minimums and maximums for the investment or investor?
Minimum investment is $50,000 US. Maximum investment is the size of the project. So if we have a $7.5 million project, then potentially all of that is available to investors.
Okay, just one from me is, how is this treated from a US citus tax perspective?
Yeah, so on inheritance tax basis, it would be treated, and it would fall into that threshold, I believe, and I haven't checked it recently, Lawrence, but the latest I recall is the threshold is about $60,000 US. So any amount above that would obviously therefore be taxed for inheritance tax purposes in the US accordingly. As always, the one thing I would add is that through a thorough insurance structuring, of course, you can cover any potential liability there by building that into your own insurance plans. But yes, there would be estate tax due in the US should the worst happen.
I'm assuming that the husband and wife can buy together, and then you go up to $120,000.
Yeah, that's actually per person. So a husband could buy 60,000, the wife could buy 60,000. It would be treated completely separately.
Okay, brilliant. And then last one, if there's one or two more questions to be fired over, please do send them now. But one from Neil: do investors need to register as taxpayers in the US, and how onerous does this become for them?
Yeah, so as I alluded to earlier, we have a tax solution in place with RSM Global Tax Advisors. So in short, yes, upon exit, you would need to register for an ITIN application, an ITIN number, which is an individual tax identification number. It will be specific to the disposition of this asset. And in terms of whether it's onerous or not, that's exactly why we provide the service through RSM. And they will do the federal and state tax filing for you. Because, as you can imagine, it is fairly onerous, and most of our clients don't want to be doing that themselves.
Okay, and then last one from Manish: can a USA H-1B work visa holder invest in this? And that question is also, if the return is 131% return, so a 31% return, is that a conservative return?
So in terms of the visa, again, I would need to check, because that would be dependent upon whether that deems you to be a resident in the US at the time of purchase. If it doesn't, then you could. If it does, then obviously you'd be restricted. In terms of the return, on a 1.51 multiple, that would account for on a $100,000 investment, $151,000 total return, principal and interest. But if I've missed the question there, Lawrence, just let me.
Is that a conservative estimate?
Yeah. So with the modelling, the financial modelling that we're doing, we're always looking to base it on a conservative estimate. How much upside there could be will obviously depend on the project, but yes, in essence, it is.
Okay, and then last one from Chris: what are the costs of RSM to do the tax at the end?
Yeah, so it's $150 per year of filing. So if, for example, there were 3 takedowns, in this case, there's 2 takedowns. So in 2 takedowns, there would be 2 filings, so it'd be about $300 depending on the final schedule of takedowns, of course.
Fantastic. Thank you. Tim, if you could stop sharing your screen just for a second.
Of course.
Wonderful. Okay, thank you very much, everybody, for joining us. Tim, thank you so much. If anybody has any more questions, or if indeed you are interested in this San Antonio project, please reach out to your wealth manager or wealth management team so that they can put you in touch. One thing that Tim did not say, and he's being modest, he doesn't tell you how quick these things sell out. And so when he was excited about getting this project on, is because he knows that that globally these things move very quickly because there is only X amount of units. We regularly get feedback from him saying, here's a new project, and then a few weeks later he sends us a project that's sold out, and then we wait for the new one. So please do get in touch with your respective wealth manager with any questions or any queries on the existing projects, or Walton in particular, or if you need to have a personal webinar with Tim, he would be delighted to do that, and we can talk about your specific needs. But thank you very much for joining us today, Tim. We appreciate it, and thank you very much for everybody making the time to join us on the webinar today, and we will see you all soon. Thank you very much.
Thank you, Lawrence. Thank you, everybody. Take care. Bye-bye.